Good morning and welcome to Charting the Markets on Friday, the 7th of July 2023. Now, today at 1:30 p.m. in the UK, we expect to see US non-farm payrolls data out of the US. And that is really the important number that everybody has been looking forward to for all of this week. And yesterday, we had a much stronger than expected ADP unemployment reading, and or actually non-farm payroll reading, I should say, where we basically had 497,000 jobs being created versus an expected 226,000 in July. And that led to equity markets selling off very sharply, as now the expectations are much higher that further rate hikes are in store, not just for the Fed, but also for other global central banks. So at 1:30 today, as I said, non-farm payrolls in the US, and we expect payrolls to rise by 200,000 compared to 339,000 last month, and the unemployment rate to hold steady at 3.7%, with average hourly earnings to rise by 0.3% on a month-on-month basis and 4.1% on a year-on-year basis. And we also have one at the same time at 1:30 p.m. the Canadian employment report out, but not many people will be looking at that because everybody will be focused on the US one. But for those of you who are interested in it, we expect the unemployment rate there to hold steady, or actually to rise to 5.4%. And then that is followed at 3 p.m. by the US IV PMI data for June, and we expect the index to fall by 52.3. And this is interesting because basically a lot of PMIs recently are also in Europe, have been lower than expected, pointing towards weaker economies. And just yesterday in Germany, the manufacturing PMI was downwardly revised as well, and that didn't help the stock market either. So let's just begin by having a look at the FTSE 100 daily financial bet. And as you can see here, we have not only fallen through the late June low at 7,401, but actually went all the way down towards the March low. And you may remember that was the low we hit on the US banking crisis. And that is now really within reach. And you can see here the FTSE greatly underperforming, under indices being back in negative territory for the year. And it looks as if we may also fall through the March low in the weeks ahead. And if so, that would have very bearish implications for the chart and mean that we could actually be heading all the way back down again towards the psychological 7,000 mark, or perhaps even heading back down towards the October low from last year. So right now, it's not looking very good for the bulls with regards to the FTSE 100, because the descent we've seen has accelerated to the downside with volume, and this is really important, yesterday on those stronger jobs data, on that stronger jobs data out of the US. And basically, we do look technically quite bearish now. Resistance, in case of a small bounce being seen, comes in at the 7,331 24th of March low, and above there we've got the 7,401 low from late June. So that really should cap any short-term upside in the days and perhaps even weeks ahead. Moving on to Germany, here the technical picture is also not looking great, because what we've seen here is a very sharp acceleration to the downside, again with volume, on that stronger US data with regards to jobs creation in the US. And here we've fallen through this key support area, taking us back to mid-April of this year, between 15,710, that is to say the end of June low, and 15,625, the May low. And when you have a confluence of support levels of previous lows on the daily chart coming in a similar sort of area, then that often acts as support. And when you fall through that without even stopping and closing below technical support like that, that is actually technically significant, because it also means after having made all these new all-time record highs back in June, following the one in May, we are now forming what is called a technical reversal pattern. Can you see here? We've formed this sort of top formation. We've fallen through this key support, and we close below there. And if we have another close below that today on Friday, it would mean we have a weekly close below this key support area, which now, because of inverse polarity, will become a resistance area from a technical perspective. And it basically means that the odds are now stacked towards further downside being seen in Germany on the DAX 40, and it could take us not just down to the 22nd of March high at around 15,305, but actually towards the red line here, the 200-day simple moving average around 14,947. So that is a possible downside target for the DAX 40 in the days or weeks ahead. And let's not forget, I mean, the German economy seems to be slowing down. We've had, as I said, a German manufacturing PMI data being downwardly revised. The European Union, the Eurozone in general, basically, I should say, is also in recession, just a small one at 0.1% for the first quarter of this year. But it's not looking very good also from a technical perspective now on this daily financial bet chart of the DAX 40. So let me therefore look at the US markets, because of course the United States has a big influence on our European sessions here. And you can see here we also had a breakout to new 15-month highs in the S&P 500, taking us to 4,458 on the daily financial bet. That was marginally higher than the high seen back in June. But if you look at the bottom of my chart, you can see this here. This is the relative strength index. And here we had a lower high, which coincided with a higher high in the S&P 500. And that basically means that we have lower highs on the oscillator whilst we're making higher highs on the underlying asset. And it's called negative divergence. And in about 70% of cases, it does lead to at least a short-term correction against the main trend, in this case, the uptrend here. And we have seen that over the last few days and tested this support line going back to May now on the S&P 500. And if we were to slide through there today or next week and close below there and below yesterday's low at 4,384, then the odds are pretty high that we will be heading not just down to the late June low at 4,328, but if we break through there, that we will also form a top here and could then fall all the way back down to the orange line here, the 55-day simply moving average, or even this previous sideways trading range, taking us back to the April and May levels around 4,200 to 4,000. So that is a definite possibility if we were to fall through 4,328. First of all, though, we have to see whether the support line here holds, and if not, whether that last reaction low holds. As long as it does, we're still technically in uptrend. If it were to give way next week, we could be heading much lower and pretty quickly over the next few weeks. The US dollar has also been quite volatile of late. It didn't really appreciate yesterday on the stronger than expected ADP employment data. And if you look at the British pound, for example, you can see here that the British pound against the US dollar actually accelerated to the upside and briefly hit 127.81, a one-week high, before coming back into its previous range of this week. As you can see here, we are still well above the April to July uptrend line. And if I zoom out here, we can see that we've just been drifting high over the last week or so, hitting that 127.81 high. And that now needs to be taken out for us to head back up again towards the June high around 128.48. And from a technical perspective, provided we stay above yesterday's low at 126.74, further upsides likely in store, as the Bank of England is expected to continue to hike its rates quite aggressively over the next few months, perhaps taking us to 6%, with even some investment banks now talking of a possibility of seeing a 7% base rate in the United Kingdom. Whether that will be the case or not remains to be seen, but the trend is still pointing towards further rate hikes, taking us much higher than where we're at now, and therefore the British pound appreciating probably further versus the US dollar. Moving on to the Japanese yen, what is interesting here is that we've come off our multi-month highs here at 145 yen and 07 sen, the June high, and are currently testing this May to July uptrend line. And as you can see here, we're actually starting to fall through this. And this is on the back of Japanese wages rising much faster and by a far bigger margin than we had anticipated. The May figure came out earlier today, and we saw the wage inflation and wage growth in Japan rise to 2.5% year on year in May, compared to an expected 1.2% rise. So the rise was more than twice what was expected, and that has led to basically some yen strength. And therefore, you can see here dollar yen coming off, testing that uptrend line, and it looks as if, given the strength of the decline we're seeing at the moment and the speed of it, that we might actually break through that uptrend line. And if so, the next downside target would be a minor level here at 142.25, taking us back to the June 20th high. But below that, the key support area is probably the May high at 140.93. So that looks to be the case, unless we were to hold here and bounce back again. But even then, we would have to take out the late June high of 145.7 for further upside to be seen on this chart. So short-term toppish with regards to dollar yen. Now, interestingly enough, the yen is also appreciating versus the euro. And as we can see here, euro yen is also coming off its multi-month high at 158 yen. And we seem to be on track to head down to the 19th of June high at 155.33. Below that, we've got some other potential support levels here at the 20th of June low at 154.05. And below there, obviously, this year's uptrend line taking us back down towards 152.60, but that's quite a long way away. But short term, basically, provided we stay below yesterday's high at 157.17, further downside remains in store with regards to euro yen as well. With regards to commodities, the price of crude oil has continued to rise over the course of this week on Saudi Arabia voluntarily extending its 1 million barrel per day output cut to the end of August. Originally, it was only planned for July. And as Russia is also cutting its output by around 500,000 barrels a day, bringing the total output cuts by OPEC Plus to around 5.19 million barrels a day. And that has led to supply concerns and pushed the price of oil higher. And as we can see on this daily financial bet of Brent crude oil, we have now risen back up towards the May to July downtrend line here. And you can see we've been trading a sideways trading range since May. And every time we seem to be hitting that resistance line here, or the downtrend line, we seem to be failing. And right now we are having difficulty in breaking above there. So it may well be that next week we might come off again, but that would only be confirmed from a technical perspective if we were to slide through the low seen on Thursday of this week at $74.97. Only then would we expect us to head back down again towards the lower end of this sideways trading range around the $72 to $71 mark. But if we were to break out of this sideways trading range and rise above the late June high at $77.24, then I would expect the previous highs, the May highs, to be retested. And these come in between $78.17, $78.52. So short term, as you can see here, as I've been saying, we've been rising for the last week or so, and further upside looks to be in store, but we need to take out that resistance line for that to be the case. Moving on to gold. If you look at spot gold, I know a lot of investors want to keep buying gold and are surprised that even though equity markets have come off quite sharply yesterday, the price of gold hasn't risen on flight to quality flows, which usually tends to happen. And you can see here, yes, we did have a light sort of rise this morning, but in the context of it basically declining since the May highs at $2,082 per troy ounce, it doesn't mean anything. And it looks to me as long as we stay below this downtrend line and below the last reaction high, that is to say a high which is higher than the previous candle and the following candle that was made last Wednesday at $1,935. So as long as we stay below there, further out, the downside is actually more likely to be seen than any upside reversal. And that would mean if we were to fall through $1,903 yesterday's low, the low from last week at $1,893 would be back in sight, and also the 200-day simple moving average at $1,867. So these are the downside targets for gold, provided we stay below $1,935. If, however, for some reason we were to accelerate to the upside, perhaps if equities start to come off even further in the course of this week, and today we've got non-farm payrolls out of the US, which are obviously very important and looked at by a lot of market participants, as it will give us a very good indication of how fast and how much the Fed will hike its rates even further from its current 5 to 5.25% Fed funds rates. And we'll have to see whether a sharp or potentially sharp decline in equity markets will push the price of gold higher. But it would have to take out $1,935, and then we could probably reintegrate the sideways trading range we've been in for much of June and take us back towards the $1,960 mark or so. But right now, technically, gold still looks bearish. And last but not least, I'd like to just briefly mention Chicago wheat, because the price of wheat had risen very sharply on basically very dry weather in the Midwest in the US, pushing the price up to $7.70 on this daily financial bet at the end of June. But since then, the weather patterns have shifted and the price of wheat has come off again. And we've also fallen now through this May to June uptrend line and are trading a sideways trading range. And I'm mentioning this today because basically from a technical perspective, if we were to slide through the low seen this Monday at $6.41, then I would expect us to head back down again towards the psychological $6 mark and perhaps even the late May low at $5.82. And if, however, we were to be able to rise above Wednesday's high at $6.82, then we might have a retest of the $7 mark and also the high seen back in April at $7.16. So right now we're just in this sideways trading range, and it'll be interesting to see which way we're going to break out of it. I suspect it will be to the downside, simply because we've had this sharp descent over the last 2 weeks, and then we are trading sideways, and then normally would expect another down leg to be seen. So that is my preferred scenario at the moment, provided we stay below $6.82. Therefore, further downside looks to be more likely than any upside. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is AxelR_IG.